Welcome back to the Deep Dive. We are your guides, here to navigate the, well, often complicated world of business and finance. We cut through the noise to bring you the core insights.
That's right. And today we're revisiting a company we looked at before Genting Malaysia, or GenM.
Yes, our last deep dive covered their Q4 2024 results, which wrapped up their financial year. Now we've got the numbers for the first quarter of 2025.
It's a really important update. Gives us the first proper look at how they've kicked off the new year.
And like always, we've grounded our analysis in a solid set of sources. We've got analyst reports here from Hong Leong Investment Bank, Phillip Capital, Public Bank, TA Investment Management.
Plus the company's own official quarterly announcement, naturally. And there's also a dedicated analysis looking specifically at the recent leadership changes and a related news piece.
So a good mix, using all these different perspectives is, well, it's crucial, isn't it?
Absolutely. It lets us see not just the numbers they reported, but critically, how those numbers stack up against what the market was expecting. It helps us understand what analysts are focusing on and the whole context surrounding the company.
Exactly. So think of this as your shortcut. Our mission today is to pull out the really important nuggets from all this material. We want to understand what actually happened in GenM's Q1 2025.
How it compares to Q4 2024.
Right. And maybe most importantly, what it all might mean for the company's direction and its financial health going forward. I'm actually pretty keen to get into these numbers and sort of unpack the story behind them.
And I'm ready to help piece that together, point out what really stands out from these reports for you to grasp.
Okay, let's dive in then, starting with the big picture. Yeah, the headline figures. Did GenM actually hit the mark in Q1 2025? What were the main reported results?
Okay, so looking at Genting Malaysia's official announcement, the reported revenue for the first quarter, ending March 31st, 2025, it came in at RM 2,595.2 million.
Let's call it 2.6 billion ringgit. How does that compare?
Well, compared to the same quarter last year, Q1 2024, that's actually a slight dip. It was RM 2,764.9 million back then. So, yeah, revenue down a bit year on year.
Okay, revenue down year on year. What about the bottom line, the net profit?
Right. The reported net profit for Q1 25 was RM 72.6 million. Now, here's where it gets interesting. Compared to Q1 24, where the reported net profit was RM 57.8 million, this Q1 25 figure is actually up.
Hold on. Revenue went down year on year, but the reported net profit went up. That feels counterintuitive.
It absolutely does. And this is really the first point where looking at the analyst reports gives us that crucial extra layer. See, when analysts assess performance, they often focus on what they call core or normalized net profit.
Or stripping out the unusual stuff.
Exactly. Items that aren't considered part of the main operational business or one-offs. Phillip Capital, for instance, they calculated a core net profit for GenM in Q1 25 of only RM 54 million.
Okay, 54 million core versus 72.6 million reported. That's quite a gap.
It is. And Phillip Capital points out that this core profit figure, the RM 54 million, was down sharply 76% compared to their calculation of core profit for Q1 2024.
Wow, 76% down on the core operational profit.
Yes. And crucially, Phillip Capital says this RM 54 million core profit missed both their own forecast for the quarter and the general market consensus estimates.
So the market was expecting better underlying performance.
It seems so. And Public Bank's report echoes this sentiment. They noted that GenM's normalized net profit came in below both their own full-year forecast and the market consensus full-year forecast.
Okay, so the reported profit number got a boost from something, while the actual underlying operational performance, the core profit, was weaker than analysts anticipated.
Yeah.
What caused that difference? What were these non-core items boosting the reported figure?
The biggest single factor boosting that reported net profit in Q1 2025 was an unrealized foreign exchange translation gain.
Forex gain.
Yes. Public Bank specifically mentions a RM 50.4 million unrealized Forex translation gain, and they link it to GenM's US dollar-denominated borrowings. The company's own announcement breaks it down slightly differently, listing RM 52.3 million in net foreign currency exchange gains within the profit and loss statement.
So just to be clear, because they hold debt or maybe assets in US dollars, and the ringgit moved against the dollar during the quarter, they recorded an accounting gain when translating that position back into ringgit for their reports.
That's exactly it. It's purely an accounting adjustment. If the ringgit weakened against the USD, for example, the value of their USD debt, when expressed in ringgit, would look smaller on paper. That creates a gain.
But it's not actual cash flowing in from running their resorts or casinos.
Precisely. It's not cash from operations. It's simply the effect of currency swings on their balance sheet items when they report in ringgit.
So the headline reported net profit looked okay, maybe even decent, being up year on year, but that was largely thanks to this Forex accounting boost. The money they actually made from running the business, the core operations, that was weaker than expected.
That's the crucial takeaway from the analyst perspective. The operational performance, measured by that core profit, was softer than anticipated. It's why Phillip Capital used the term missed expectations, and Public Bank's report title was pretty blunt. Earnings recovery remained weak. You really need to focus on the operational picture, separate from these accounting gains.
Understood. And just quickly, that Star article mentioned much bigger numbers, revenue around 6.5 billion ringgit.
Yes, good point to clarify. That article seems to be talking about the overall Genting Berhad Group results. That includes GenM's leisure business, but also their plantations, property, cruise lines, all sorts of other things.
Okay.
Our focus here is specifically on Genting Malaysia, and their numbers from their own announcement and the analyst reports focusing on GenM are that RM 2.595 billion revenue and the RM 72.6 million reported net profit.
Got it. Stick to the GenM specific figures. Okay, let's dig deeper then into the financial health beyond just that headline profit number. What can we see about their revenue mix? Gaming versus non-gaming, and maybe the VIP versus mass market split within gaming.
Yeah, unfortunately, the sources we have don't give us a neat percentage breakdown for all of that. We don't see a specific split between gaming and non-gaming revenue overall, or the precise VIP versus mass market numbers for Resorts World Genting. However, Phillip Capital does call out one very specific factor contributing to the lower overall revenue, and that was a pretty significant drop in Resorts World Genting's VIP gross gaming revenue, or GGR.
How significant are we talking?
Phillip Capital states that RWG's VIP GGR was down a noticeable 18% year-on-year, so Q1 25 versus Q1 24, and it was also down 19% quarter-on-quarter compared to Q4 24.
Wow. Almost a 20% fall on the high roller segment, whichever way you compare it. Yeah. What does that suggest about their gaming business, especially at the main Genting Highlands resort?
Well, it really indicates that the recovery, or maybe just the current performance in that VIP segment at RWG, is still facing some pretty stiff headwinds. This segment, it often relies on international high net worth players.
Right.
And their activity can be quite sensitive to things like the global economy, travel patterns, regional competition, that sort of thing. A 19% drop just from Q4 to Q1 is quite substantial. It clearly dragged down the overall revenue number, as Phillip Capital highlighted.
Even with Chinese New Year happening in Q1, you'd think that might boost things.
You would, wouldn't you? But it suggests that even with the festival period, the VIP segment just didn't perform strongly. Public Bank also mentioned that the overall Malaysia business saw its adjusted EBITDA fall by 11.2% year-on-year, which sort of underlines the challenges in that domestic operation, possibly linked to this VIP weakness.
Interesting. So weakness in that high-margin VIP area seems to have been a key drag on revenue. Even if maybe the mass market or non-gaming did okay, we don't have the specific splits, but that VIP drop is clear.
That seems to be the main takeaway from the sources on the revenue side.
Okay, let's look at another key profitability metric then, EBITDA margin. You mentioned adjusted EBITDA was down year-on-year from Malaysia. How did the overall EBITDA and margins look? The numbers seem a bit jumpy.
They are quite volatile, especially comparing quarter-on-quarter. So according to GenM's own announcement, the reported EBITDA was RM 705.1 million in Q1 25. Now, that's up 14% compared to the RM 615.9 million in Q1 24, so a year-on-year increase in reported EBITDA.
Okay, up 14% year-on-year.
But the jump from the immediately preceding quarter, Q4 2024, is huge. In Q4 24, reported EBITDA was only RM 142.0 million, so it went from 142 million to over 705 million in just one quarter.
That is a massive increase quarter-on-quarter. What drove that?
If we look at adjusted EBITDA, which often gives a clearer operational picture, the story is similar. It was RM 737.2 million in Q1 25. That's up 13% from RM 654.1 million in Q1 24. And again, the jump from Q4 24 is dramatic. Adjusted EBITDA in Q4 24 was just RM 180.6 million.
So again, a huge QOQ jump. What was the reason given?
GenM's announcement attributes this big quarter-on-quarter improvement mainly to higher adjusted EBITDA coming from their core leisure and hospitality business, suggesting a strong operational rebound from whatever happened in Q4.
Okay, so operationally, Q1 2025 was way better than Q4 2024. But what about the actual margin percentage? Phillip Capital's table seemed to show the margin actually went down slightly year on year.
That's correct. Phillip Capital calculates the EBITDA margin at 26.5% for Q1 25, and that is indeed down by 1.9 percentage points from the 28.4% margin they recorded in Q1 24.
So even though the absolute amount of adjusted EBITDA was up year on year, the profitability they squeezed out of each ringgit of revenue actually decreased a bit.
Exactly. That can happen if, say, revenue falls more sharply than costs, or perhaps if the business mix shifts towards segments that naturally have lower margins.
And Phillip Capital pointed to the Malaysia and U.S. operations dragging down the year-on-year EBITDA comparison.
Yes, they did. And if you look deeper into the segment EBITDA margins that Phillip Capital provides in their table, that year-on-year margin contraction seems pretty broad-based. Malaysia's margin dipped about 1.4 points. The UK margin contracted more, by 3.3 points.
And the U.S.?
The U.S. saw a bigger drop, down 5.9 percentage points. Even the smaller properties segment margin fell significantly, by almost 8 percentage points year-on-year.
Wow. So it wasn't just one area. It seems efficiency or maybe pricing power was challenged across most parts of the business compared to the same time last year, even as the total adjusted EBITDA grew.
That's what the segment margin data suggests. So the overall EBITDA story is a bit mixed, isn't it? You've got this dramatic recovery from a really weak Q4 24, which is positive. Maybe seasonal factors like Chinese New Year help, maybe better cost management than Q4.
Wow.
But you also have this slight year-on-year margin squeeze across most segments, hinting at some...
Okay, that makes sense. A mixed picture there. Let's talk debt. How are their borrowing levels looking, and critically, their ability to handle that debt?
Hong Leong Investment Bank's report gives us a useful forecast trajectory. They had net debt estimated at around RM 8.7 billion at the end of fiscal 24, and they project that gradually coming down over the next few years.
So much down.
They see it potentially reaching around RM 7.1 billion by the end of FY27. Their net gearing ratio, that's debt relative to equity, was 0.7 times at the end of FY24. HLG forecasts that staying pretty stable, around 0.7x for the next couple of years, then maybe dipping slightly to 0.6x in FY27.
Okay, 0.7x gearing, is that considered high for this kind of business?
It's moderate, I'd say. For capital-intensive business like integrated resorts, 0.7x isn't alarmingly high, but it's definitely not low leverage either. The fact HLG sees it staying stable suggests they think the company's cash flows can manage this level, allowing for gradual reduction over time.
And the official numbers from GenM?
Their Q1 announcement shows total borrowings, short and long term, combined at about RM 12.2 billion as of March 31st, 2025. That's actually slightly lower than the figure at the end of December 2024. So stable to slightly decreasing, which aligns with the HLG view.
Right, but didn't you mention earlier that the cost of servicing this debt went up significantly?
Yes, that's the crucial counterpoint. Even if the total debt pile isn't growing, the interest they have to pay on it can change, and it did. Interest expense in Q1 25 was RM 184.2 million. That's a hefty 26% increase compared to the RM 146.4 million they paid in Q1 24.
26% higher interest costs year on year. Why?
Phillip Capital explains it's mainly due to two things: refinancing some existing debt back in Q4 of 2024, presumably at higher rates, and also issuing some new medium-term notes in the second quarter of 2024.
So they've essentially locked in higher interest payments on parts of their debt portfolio, even if the total amount borrowed hasn't changed much.
That seems to be the case. And that increased cost directly hits the bottom line, right? It puts pressure on net profit even before you consider how the core operations performed. It's definitely an important piece of the financial puzzle right now.
And connecting back to the Forex impact we discussed, just how exposed is GenM to these currency fluctuations, like the ringgit versus the U.S. dollar?
It's pretty significant, mainly because of their substantial operations and investments overseas, particularly in the UK and the US, and also because of those US dollar borrowings we just talked about. That RM 52.3 million net Forex gain that boosted the P&L in Q1, that's a direct result of these exposures.
Right.
But it's not just the profit and loss impact. If you look at their statement of comprehensive income, which includes stuff that doesn't necessarily flow through net profit immediately, you see even bigger swings from translating their foreign operations.
How low?
Well, in Q1 2025, they actually recorded a loss of RM 44.5 million from net foreign currency exchange differences on translation of foreign operations. But compare that to Q1 2024. In that quarter, the same line item showed a massive gain of RM 290.4 million.
Wow, so huge swings in the reported value of their foreign businesses on paper, just due to currency movements affecting comprehensive income.
Precisely. It means a noticeable chunk of their overall reported financial position, especially when you look beyond just net profit, is subject to the whims of global currency markets because of their international footprint and their USD debt. It's non-cash mostly, just accounting adjustments reflecting the changing ringgit value of foreign assets and liabilities.
And can swing both ways, helping the P&L in Q1 through the debt translation, but hurting comprehensive income through the operations translation.
Exactly, and it underlines why analysts try to focus on core profit or operational metrics like EBITDA, which are less distorted by these purely translation-related effects.
Makes sense. Okay, let's shift focus to dividends, always a key question for investors. Can GenM keep the payouts coming? Did they actually pay anything in Q1?
The Q1 announcement from the company is very clear on this. No dividend has been paid for the 3 months ended 31 March 2025.
Right, which is normal. Dividends aren't usually quarterly.
Correct. They typically declare and pay semi-annually or maybe annually.
So no surprise for Q1 itself.
Yeah.
But what are the analysts thinking about future dividends based on these reports? Are they expecting payouts to continue?
Hong Leong Investment Bank gives us some specific forecasts here. They are projecting a net dividend per share, DPS, of 10 sen for the full financial year 2025, and the same again for FY26.
10 cents per share for this year and next.
Yes. And then they forecast a small increase, up to 11 sen in FY26 and 12 sen in FY27. Based on their target price for the stock, HLG translates this into forecast dividend yield starting at 5.5% for FY25, rising gradually to 6.0% for FY26 and 6.6% for FY27.
Okay, so HLG is clearly anticipating continued dividends, even nudging up slightly over the medium term. But wait a minute. Earlier, we heard that core profit missed expectations, and you said HLG themselves are forecasting a core earnings per share, EPS, of only 5.5 sen for the full year FY25.
That's right. Their forecast core EPS is 5.5 sen.
So how can they forecast a 10-cent dividend payout when they only expect the company to earn 5.5 cents per share in core profit? That implies a payout ratio of, well, almost 200% of core earnings. How sustainable is that?
That is an excellent point, and it flags a potential concern about dividend sustainability from earnings alone. A payout ratio that high, significantly above 100% of core earnings, means the company isn't covering the dividend from its current operational profit.
So where would the money come from?
It would have to come from other sources, either from accumulated reserves, profits saved up from previous more profitable years, or potentially it could be supported by strong underlying cash flow generation, even if the accounting profit is lower due to things like high depreciation charges or those non-cash Forex effects we discussed.
Okay, so maybe the cash flow picture is stronger than the core profit picture suggests.
That's the likely rationale behind HLG's forecast, especially since their projections also show GenM's cash balance increasing over the next few years, suggesting they anticipate sufficient cash generation or perhaps existing reserves to cover the payouts. Let's look at the Q1 cash flow statement.
What did it show?
Cash flow from operations, CFO, in Q1 25 was RM 424.1 million. Capital expenditure, or CapEx, was RM 227.9 million during the quarter.
How does that compare to last year's Q1?
It's actually lower on the operating cash flow side. In Q1 24, CFO was higher at RM 517.0 million, and CapEx was lower back then too, at RM 176.4 million. So in this latest quarter, they generated less cash from operations and spent more on investments compared to Q1 last year.
Okay, so we calculate a rough free cash flow for Q1 25, that's CFO minus CapEx.
Right, so RM 424.1 million minus RM 227.9 million. That gives us about RM 196.2 million in free cash flow for the quarter. That's the cash generated before they deal with financing stuff like paying down debt principal or distributing dividends.
Okay, nearly 200 million ringgit in free cash flow in one quarter. If you annualize that, maybe it could support some level of dividend alongside meeting debt obligations.
It potentially could, yes. So while Public Bank expresses caution due to poor earnings visibility, which naturally raises questions about dividend cover from earnings, HLG's forecast of continued dividends alongside rising cash balances suggests they believe the underlying cash generation, or perhaps existing cash reserves, are strong enough to maintain those dividend payments, despite the potentially thin cover from core profit in the near term.
So it's a case where you really need to look beyond just the profit number and consider the cash flow and the balance sheet strength when thinking about dividend sustainability.
Exactly. It's a more nuanced picture than just looking at the earnings payout ratio.
All right, let's move on to potential red flags. Things investors should be wary of. One that often comes up for gaming companies is the risk of gaming tax hikes. Was that mentioned in any of the sources?
Yes, it was. The analysis piece focusing on the leadership change does list potential gaming tax changes as one of the external factors or macro headwinds that the company faces.
Okay, so it's acknowledged as a risk. But were there any specifics, any recent news or government proposals mentioned in these reports suggesting a tax hike is actually on the table right now?
No, none of the analyst reports or the news article provided mention any specific current news about impending tax hikes. Based only on these sources, it's flagged as a general industry risk, a potential negative factor hanging out there, but there's no concrete indication from this material that it's happening imminently.
Got it. So on the radar, but not an active current issue, according to these sources.
Right. What did significantly impact their tax expense in Q1 2025, though, wasn't a rate hike, but something else mentioned by Public Bank and in GenM's own announcement. It was the end of certain tax incentives they had been benefiting from.
Ah, the end of a benefit. Which scheme was this?
It was related to the Genting Integrated Tourism Plan, or GITP. Because those incentives expired or were fully utilized, their income tax expense jumped quite dramatically. The GenM announcement shows it went from about RM 79 million in Q1 24 up to RM 132 million in Q1 25.
That's a big jump in tax paid.
It is. And Public Bank's table actually calculates the effective tax rate for GenM in Q1 25 at a staggering 71.75%.
71.75%. That seems incredibly high for a corporate tax rate.
It is extremely high. GenM explains this isn't just due to the incentives ending, but also because of certain expenses that aren't deductible for tax purposes, and also because they weren't able to recognize deferred tax assets related to some losses, basically. They couldn't get an immediate tax benefit from some past losses yet. There were some remaining incentives utilized, which partially offset this, but the net effect was that very high effective tax rate.
So to be clear, the government didn't raise the tax rate, but GenM's effective tax costs shot up because a major incentive program ended and due to these other accounting and tax factors.
Exactly. It's a crucial distinction. The impact on the bottom line is similar to a tax hike, higher tax expense, lower net profit, but the cause is different. It's the expiry of a previous benefit coupled with these other technical tax reasons, and it's certainly a material negative impact compared to previous periods.
Okay, that's clear. Another potential risk area often discussed is dependence on the China VIP segment, especially given that drop in VIP GGR you mentioned earlier. Did the sources quantify this dependence or give more color on trends?
They didn't provide a specific percentage, no. We don't know exactly what slice of RWG's revenue comes directly from Chinese VIP players based on this material. However, Public Bank did make a relevant comment.
What was that?
They noted that the Malaysian government has extended the visa exemption policy for Chinese tourists right through to the end of 2026. And Public Bank views this positively, saying it should augur well for Malaysia's tourism and hospitality industry overall.
Okay, so the government policy is seen as supportive for attracting Chinese tourists in general, which should benefit RWG. But does that connect back to the VIP segment weakness?
Well, you can piece it together. Public Bank sees the visa policy as a general positive tailwind for tourism into Malaysia. But Phillip Capital's specific data point, that 19% quarter-on-quarter and 18% year-on-year fall in RWG's VIP GGR points to continued weakness in that particular high-value segment.
So maybe the visa-free travel helps bring in more mass-market tourists from China, but the high rollers, the VIPs, aren't coming back as strongly yet, or maybe facing other issues.
That's a reasonable inference based on combining those two pieces of information. While we don't have the exact numbers, it suggests that the performance of the VIP segment, which is likely significantly influenced by trends in key source markets like China, remains a crucial factor and currently a bit of a headwind for RWG's overall revenue, even if general tourism gets a boost.
Okay. Makes sense. Bit of a double-edged sword there, potentially. Let's talk about another red flag, active lawsuits or regulatory actions. Were there any major legal battles mentioned?
Yes, there was one very significant piece of ongoing litigation detailed in the GenM announcement. It involves their operations in the Bahamas.
Okay, what's the story there? Who's involved?
The lawsuit was filed by a company called RV Bahamas, Inc. They are suing Genting Americas, Inc., or GAI, which is an indirect, wholly owned subsidiary of Genting Malaysia.
And what's the dispute about?
It relates to the operations of Resorts World Bimini down in the Bahamas. RV Bahamas holds a minority stake, about 22%, in the entity that owns and operates RW Bimini. Genting Malaysia, through its subsidiaries, holds the controlling 78%. And RV Bahamas is suing GAI for damages, exceeding USD 600 million.
600 million US dollars plus. That is a very substantial claim. What's Genting's position on this?
GAI's stance, as laid out in the GenM announcement, is that they firmly believe the complaint is baseless and completely without merit. They argue the whole thing should be handled as a shareholder dispute under a pre-existing shareholders agreement, not through the U.S. courts.
Okay.
They also contend that the claims are time-marred, meaning filed too late, and that the complaint just doesn't provide enough factual basis to proceed. So they're pushing back hard.
Right. Strongly defending their position. What's the current status of the case then?
According to the announcement, GAI has formally filed a motion asking the court to dismiss the complaint entirely. There was also an attempt at mediation. The parties held a session on May 8, 2025, specifically trying to reach a settlement.
And did that work?
No. The announcement states they couldn't reach a resolution during that mediation session. So the case is now moving forward in the U.S. court system. They've entered the fact discovery phase, where both sides start gathering evidence, documents, testimonies, and so on.
Okay, so mediation failed, dismissal motion pending, but the case is proceeding for now. When you see something like this in a quarterly report, what's the key takeaway for you?
The main takeaway is that this is a material, ongoing legal battle with a potentially very large financial exposure attached. Over USD 600 million is serious money. Just for context, Public Bank mentioned GenM's total market value is around 10.3 billion ringgit. 600 million US dollars is roughly what? 2.8 billion ringgit?
Yeah, a significant fraction of their market cap.
Exactly. So even if GAI is confident in their defense and believes the case is baseless, a potential liability of that magnitude represents a significant ongoing risk.
Wow.
An unfavorable outcome, while maybe not likely in their view, could have a really material impact on Genting Malaysia's financials. It's definitely something that needs to be watched very closely as it develops.
Absolutely, a major item to monitor.
Yeah.
Okay, let's shift to the future outlook now. What's management focusing on? We've talked about Genting SkyWorlds theme park before, and some of the criticisms around its cost and initial performance. What's the current plan for GSW, according to these sources?
Right. The leadership change analysis does mention that GSW faced that past criticism, massive cost overruns, delays, and an initial opening performance described as underwhelming. It clearly represents a huge capital outlay for the company.
So is the focus now on expanding it? Is there talk of a phase 2 or adding major new rides?
Interestingly, based only on the sources we have for this deep dive, there's actually no mention of a SkyWorlds Phase 2. All the references to GSW, both in the leadership change analysis and the company's own Q1 announcement, seem to focus squarely on optimizing the existing park.
Okay. So less about building more right now and more about making the current very expensive park work better and deliver returns.
That seems to be exactly the priority, according to these sources. The leadership change analysis explicitly states that optimizing GSW is a crucial task for the new CEO, Lee Chung-yan. The emphasis appears to be on executing a turnaround strategy for the park.
Which involves what?
Things like optimizing the current operations within the park, improving cost controls related to running it, enhancing the overall visitor experience, and ultimately trying to drive better financial returns from the substantial investment that's already sunk into it. It really sounds like the focus is on maximizing the value of the asset they've already built.
Okay, focus on execution for GSW. What about management's overall guidance or targets for 2025? Did the Q1 results prompt any changes there?
Well, the official Genting Malaysia announcement makes it clear the group did not issue any specific profit forecast or profit guarantee for the financial year. They're not giving hard numbers.
Yeah, the analysts.
Public Bank, in their report covering the Q1 results, explicitly state that they are retaining their earnings forecasts for now, given the poor earnings visibility.
Poor earnings visibility. That sounds like caution. So it's less about setting new targets and more about a wait-and-see approach.
Yes, that's the general feeling you get. Management's own commentary in the announcement talks about navigating ongoing global uncertainties and challenges in the regional gaming market. They express cautious optimism for the near term and remain positive longer term, but it's framed more around strategic execution than specific financial projections.
What are those key strategic priorities they mentioned across their different locations?
They outlined several key strategies in the announcement, and the Star article picked up on some too. For Resorts World Genting in Malaysia, the focus is on enhancing its appeal. This includes adding new facilities and attractions, but also, interestingly, developing new ecotourism experiences, plus the usual focus on yield management, operational efficiency, service delivery, and careful cost control.
Okay. What about overseas? UK.
In the UK, the strategy seems geared towards expansion and grabbing more market share. They specifically mention the recent acquisition of Asper's Stratford Casino in London as a key move. And they say they're exploring other acquisition opportunities too, alongside improving the products at their existing UK casino.
And the US big market there.
The major strategic play in the U.S. mentioned is their plan to acquire the remaining 51% of Genting Empire resorts that they don't already own. This deal needs regulatory approval, but the goal is to fully integrate the operations of Resorts World, New York City, and Empire Resorts.
Synergies, presumably.
Exactly. They're aiming for synergies through cross-marketing, sharing resources, things like that, to really strengthen their position in that competitive New York market. They also mentioned they're keeping a close eye on the whole process around awarding new downstate casino licenses in New York.
Right. That's a big potential opportunity. And finally, the Bahamas. Resorts World Bimini.
For RW Bimini, the strategy is all about driving more visitors. They're implementing an expanded cruise strategy, trying to get more cruise ships to call there. They're also hoping to benefit from potentially increased airlift coming from Miami towards the end of 2025. Alongside this, the focus is on optimizing operations and managing costs.
Okay, so quite specific strategies outlined for each major operating region. Let's zoom back in now to the recent performance and specifically compare Q1 2025 against the quarter immediately before it, Q4 2024. We know Q1 saw a big rebound, but what are the top, say, 3 improvements and the top 3 declines quarter on quarter?
Okay, comparing Q1 25 to what was clearly a very weak Q4 24 does highlight a significant operational turnaround. The most dramatic improvements were definitely in adjusted EBITDA and profit before taxation.
Just how big was that leap again?
Adjusted EBITDA went from just RM 180.6 million in Q4 24 up to RM 737.2 million in Q1 25. That's a jump of over 300%, a massive operational recovery, which GenM attributed mainly to their core leisure and hospitality business performing much better.
Okay, that's improvement number 1. What's number 2?
The swing in profit before taxation, PBT. It went from a significant loss of RM 368.2 million in Q4 24 to a profit of RM 184.0 million in Q1 25. This huge swing reflects that underlying operational improvement we saw in EBITDA, but also the absence of large exceptional negative items that must have hit the Q4 numbers. GenM also specifically noted lower write-offs of property, plant, and equipment in Q1 compared to Q4, which helped the PBT figure.
So huge jump in adjusted EBITDA, massive swing from PBT loss to profit. What's the third key improvement versus Q4?
I'd say it's the underlying cost control. While revenue itself was actually slightly down quarter on quarter, the operating costs must have come down significantly more compared to Q4 to allow for that huge EBITDA rebound. Phillip Capital's table, for instance, showed operating costs down almost 13% quarter on quarter. That improved cost management relative to Q4 was crucial for the profitability swing.
Right, better cost control driving the margin rebound from Q4. Okay, so those are the big positives versus Q4. What about the declines quarter on quarter? What got worse?
Well, the most obvious decline, even if the impact was outweighed by cost improvements, was revenue itself. As we noted, it was down slightly 4.9% according to Phillip Capital, 6.1% per GenM's figures compared to Q4. Phillip Capital attributed this mainly to that 19% QOQ drop in RWG VIP GGR, plus some expected seasonality in the U.S. operations after the Q4 holiday period.
Okay, revenue dip is decline number 1. What else?
The GenM announcement notes also highlight a higher share of losses coming from their associate companies in Q1 compared to Q4. That negative contribution increased by RM 5.5 million quarter on quarter. That's decline number 2.
And number 3.
Higher finance costs. As we discussed earlier, due to refinancing and new notes, the interest expense burden increased. It was RM 19.6 million higher in Q1 25 compared to Q4 24.
Okay, so putting it all together, the Q1 versus Q4 story is really about a strong operational rebound from a very poor Q4, driven by much better cost management and maybe seasonal factors like Chinese New Year lifting operations, resulting in that big swing back to profitability before tax.
But offset somewhat by slightly softer overall revenue, dragged down by VIP performance and U.S. seasonality, plus higher losses from associates and that increase in finance costs.
That seems to capture the key quarterly shifts well. Okay, finally, let's connect this all to the leadership impact. We know Lee Chung-yan took over as CEO from Tan Sri Lim-kok Tair right at the beginning of Q1 2025, on January 1st. How does the analysis of that change fit with these Q1 results in the bigger picture?
It provides really important context. As the leadership change analysis details, Tan Sri Lim-kok Tair, or LKT, stepped down as CEO of Genting Malaysia, and Lee Chung-yan, who was already president and COO, stepped up into the CEO role.
And as you mentioned, this wasn't just a routine handover. It came after intense shareholder pressure.
It absolutely did. And the analysis digs into why that pressure existed. A huge sticking point was LKT's compensation package as GenM CEO. It was seen by many shareholders as excessive, especially when you compared it to the company's performance relative to its peers.
The analysis mentioned some big numbers.
Yes, it highlighted his annual pay running potentially RM 60-80 million pre-pandemic and still being very substantial, maybe RM 30-40 million, even during the pandemic years when GenM was reporting losses.
And all this while the share price was lagging.
Exactly. The analysis pointed to GenM share price being down roughly 40% over the preceding 5 years, and its profit recovery post-pandemic being slower than some key competitors. This gap between the top executives' pay and the company's performance really fueled shareholder anger,
leading to pushback at meetings.
Yes, the analysis notes consistently high against votes, anywhere from 20 to 40% opposing LKT's re-election and his remuneration packages at the annual general meetings. This included significant votes against from major institutional investors like Malaysia's EPF and negative recommendations from influential proxy advisory firms like ISS and Glass Lewis.
So the decision for LKT to step down specifically as CEO of GenM looks like a direct response to this sustained and very public shareholder grievance about pay versus performance.
That's certainly the narrative presented in the analysis.
What are the implications then, according to this analysis? What does the change mean?
On the positive side, the analysis suggests several benefits. First and foremost, it directly tackles that major shareholder complaint about CEO pay. The new CEO, Lee Chung-yan, is expected to have a significantly lower compensation package, which should lead to noticeable cost savings for GenM on the executive pay front.
Okay, cost saving is one. What else?
Secondly, it's seen as improving the corporate governance optics. It creates a clearer separation between the chairman role and the CEO role at the Genting Malaysia operating company level, which is generally viewed favorably by governance watchers. This responsiveness to investor feedback might also boost market sentiment towards the stock.
It's not like LKT has disappeared entirely from the picture, right?
No, not at all. And that's the crucial nuance, the potentially neutral or uncertain aspect highlighted in the analysis. LKT remains the executive chairman of Genting Malaysia. He also remains executive chairman of the parent company, Genting Berhad, which holds the controlling 49% stake in GenM, and he's still CEO and chairman of Genting Singapore.
So he's still very much involved at the highest levels and through the parent company hold ultimate control.
Precisely. So while Lee Chung-yan is now clearly in charge of the day-to-day running of Genting Malaysia, the execution, the operations, the ultimate strategic direction, major decisions on capital allocation, big M&A deals, group strategy, those are still likely heavily influenced, if not ultimately decided, by LKT in his executive chairman capacity and via the controlling shareholding.
Okay, so it's a change in who's managing the operational engine day to day, putting a seasoned operational expert like Lee Chung-yan in charge, which sounds positive for execution, but maybe not a fundamental shift in who's steering the overall ship strategically.
That's exactly the interpretation the analysis provides. Lee Chung-yan's background is deeply operational, especially at RWG. And his stated priorities, as listed in the analysis, things like executing the turnaround, optimizing GSW, improving cost controls, enhancing customer experience, they align perfectly with the operational focus areas we saw mentioned in GenM's own Q1 announcement.
So the change puts operational execution front and center under a known quantity, addressing the pay issue. But the overarching strategic framework, potentially influenced by the chairman and controlling shareholder, might remain consistent.
That seems to be the balanced view presented. The change is seen as a positive on the governance and operational execution front, while acknowledging the continuity of strategic influence from the top.
Wow, what a journey through Genting Malaysia's Q1 2025. We've covered a lot of ground, from the headline numbers and why reported profit differed from core, through the details of financial health like margins and debt costs, the dividend outlook, those potential red flags like the big lawsuit and the impact of ending tax incentives, the future strategies for GSW and overseas ops, that key comparison back to Q4, and finally, placing it all in the context of that significant leadership change.
And hopefully, by digging into these details, understanding the why behind the numbers, looking at it from different angles, using the analyst reports and the company's own statements, hopefully this gives you, the listener, a much richer, more informed view than you'd get from just a quick news headline.
Absolutely. And as you digest all this information, maybe take a moment to think about what really stood out most to you. Was it the impact of that unrealized Forex gain masking a weaker core result? Or maybe the way EBITDA margins contracted year on year across almost all segments. Perhaps the sheer size and ongoing nature of that USD 600 million plus lawsuit in the Bahamas got your attention. Or the nuances around the CEO change, addressing a key shareholder issue but leaving ultimate strategic control largely unchanged.
Yeah. And maybe a final thought to leave you with. We saw quite a range of analyst views mentioned hold recommendations from Hong Leong and Phillip Capital, a more cautious trading sell from Public Bank, and even a buy call from TA Investment Management. Given this mix, the signs of operational recovery quarter on quarter, but alongside these ongoing challenges like underlying profitability pressures, rising finance costs and taxes, significant potential risks like that lawsuit, and maybe lingering questions about corporate governance and concentrated strategic control. How much weight do you personally place on the green shoots of operational improvement versus these persistent risks and structural factors when you form your own perspective on Genting Malaysia?
It is certainly a complex picture with lots to weigh up. Thank you for joining us on this deep dive. We'll be back again soon to unpack another important topic, aiming to bring you those essential insights straight from the source material.
Until next time.